You know what makes me genuinely angry? The fact that 90% of Indians watching this video are sitting inside at least one financial scam right now, and they have absolutely no idea. These are not Bitcoin scams. These are not Telegram pump and dump groups. These are not Ponzi schemes that make headlines. These are quite legal, IRDAI approved, SEBI regulated, bank sold financial products that drain lakhs from middle class Indian families every single year. Products your parents bought for you out of love. Products your bank manager sold you as, sir, this is like FDO only better. Products your friendly insurance agent showed you with beautiful PowerPoint slides full of fake numbers. And the worst part? When you finally figure out you have been scammed, it is too late to get your money back without taking a 30 to 40% hit. According to IRDAI's 2024 to 25 annual report, over 1.2 lakh formal grievances were registered against life insurance companies last year alone. Unfair business practice cases jumped to 26,667, up 14% from the previous year. These are just the people who actually filed complaints. The real number of Indians sitting in missold products silently is probably 50 to 100 times higher. Today, I'm going to walk you through the 4 biggest financial scams operating in plain sight in India. Most of you watching are in at least one of them. By the end of this video, you will know exactly what to check, what to ask, and what to do. Let us get into it. Now, let us talk about scam number 1, which is fake diversification through mutual funds. This is the one almost every Indian investor is in, and most do not realize it. Let me show you the typical Indian mutual fund portfolio I see in viewer questions every single day. A Nifty 50 index fund, a large cap fund, a flexi cap fund, a mid cap fund, a small cap fund, a multi cap fund, a sectoral fund focused on banking, another sectoral fund focused on IT or pharma, maybe a thematic fund focused on manufacturing, and often one ELSS fund for tax saving, 10 to 15 mutual funds. The investor genuinely believes they are diversified. Here is what they are actually doing. If you pull up the underlying stock holdings of all these funds, approximately 30 to 40% of the stocks repeat across them. Companies like HDFC Bank, ICICI Bank, Reliance Industries, Infosys, TCS, Bharti Airtel, Larsen and Toubro, ITC, and a handful of other large cap blue chips show up in your Nifty 50 fund, your large cap fund, your flexi cap fund, your multi cap fund, and your ELSS fund. You're not diversified. You're paying expense ratios in 10 different funds while owning essentially the same 30 stocks 5 different times. This is fake diversification, and it is the most common scam in Indian retail investing. Here is the painful truth. Real diversification is not about owning more equity funds. Real diversification is about owning genuinely uncorrelated assets: gold, debt funds, international equity, real estate. These move differently from Indian equity. 10 domestic mutual funds owning the same 30 stocks do not. Here is what you should do today. First, open your mutual fund statement on the AMFIMF Central portal. Count how many funds you own. If the answer is more than 4 or 5, you have too many. Second, check the portfolio overlap. Tools like Value Research or Money Control show you the repetition. Third, consolidate 2 index funds. Nifty 50 plus Nifty Next 50 or just a Nifty 500 fund cover almost the entire Indian equity market. Add 1 international fund for global exposure. That is your entire equity allocation done in 3 funds. Then add genuinely uncorrelated assets. 10% in gold via sovereign gold bonds, 10% in debt funds, 5 to 10% in international equity. Simple, low cost, actually diversified. Now let us talk about scam number 2, which is the ULIP and endowment plan trap your parents probably bought for you. This is the scam that hits Indian families the hardest because it is sold with love. Your parents did not buy these products to scam you. They were scammed themselves. Here is how it typically happened. maybe 15 or 20 years ago, a friendly LIC agent visited your home, or a bank relationship manager called your father. They explained a beautiful product where you invest 50,000 or 1 lakh every year for 10 to 20 years and then either get a lump sum at maturity or start receiving guaranteed monthly income. 20 years later, you open the policy document and see something called ULIP, or endowment plan, or money back plan, or guaranteed savings plan, and the actual returns anywhere between 3 to 6% annually, sometimes less. Let me break down what these products actually do. A ULIP, or unit linked insurance plan, combines insurance and investment into one product. Sounds smart, it is not. In a typical ULIP, you pay 50,000 rupees annual premium. The insurance company gives you a life cover of 10 times your premium, so 5 lakh rupees. They take a fund management charge of 1 to 1.35% annually, plus a mortality charge deducted every month from your investment units, plus policy administration charges, plus premium allocation charges that can be 8 to 10% in the early years. Then they lock you in for 5 years minimum. Now, here is a simple comparison. Pure term insurance for 1 crore cover for a healthy 30-year-old non-smoker cost approximately 8,000 to 18,000 rupees a year. Pure investment in a Nifty 50 index fund returns approximately 12% CAGR long term with 0.5% expense ratio. So instead of paying 50,000 a year for a ULIP with 5 lakh cover and 6 to 8% net returns, you could pay 10,000 for term insurance with 1 crore cover and put 40,000 in an index fund, returning 12%. Same money out of your pocket. 20 times the insurance cover, almost double the returns. The endowment plan is even worse. A typical endowment plan looks like this. You pay 1 lakh per year for 10 years. From year 2 onwards, you receive 25,000 per year as a small payback. Then from year 11, you receive 1.5 to 1.8 lakhs per year for the next 10 to 15 years. Sounds great until you do the math. If you put the same 1 lakh per year into a Nifty 50 index fund at 12% CAGR for 10 years, you would have approximately 17.5 lakhs. Then let it compound for 10 more years without adding anything. You end up with over 54 lakhs. The endowment plan, after all those years, gives you back maybe 20 to 25 lakhs total. That is a real return of 3 to 6% per year, less than a fixed deposit, less than PPF. According to Bank Bazaar analysis, these plans are mathematically incapable of beating 4 to 6% annual returns. The first year premium goes largely to agent commissions, and the rest is invested mostly in government securities, which earn near FD returns. Why do agents push these products so hard? Because ULIPs pay agents 25 to 40% of the first year's premium as commission. Endowment plans pay 25 to 35%. A term insurance plan pays maybe 5 to 10%. So you can guess which one they will recommend. Here is what to do right now. First, find out exactly what your family owns. Pull up every life insurance policy. Look for ULIP, endowment, money back, Jeevan something, or any policy that combines insurance and investment. Second, calculate the actual IRR. Take what you have paid in premiums each year and what you have received or will receive. Run it through any IRR calculator online. Most people are shocked to find the annual return is below 5%. Third, decide whether to surrender or continue. If your policy is in its first 5 years, surrender now and accept the loss. The longer you continue, the more you waste. If the policy is older, with high surrender penalties, calculate whether continuing actually beats surrendering and reinvesting elsewhere. Often surrender is still better. Fourth, if you are verbally promised guaranteed returns that the policy does not actually deliver, file a miscellaneous grievance on the IRDAI Bima Bharosa portal. If unresolved, escalate to the insurance ombudsman. The rule going forward is simple. Buy pure term insurance for protection. Buy mutual funds for investment. Never mix the two. Now let us talk about scam number 3, which is the health insurance trap most Indians do not understand. This one is genuinely critical because it affects you when you are most vulnerable. When you or a family member is sick and admitted to hospital, millions of Indians buy health insurance every year thinking they are protected. Most of them are partially protected at best, and they do not know it until it is too late. Let me explain the three biggest traps inside Indian health insurance. First, the room rent capping trap. When you buy a standard health insurance policy in India, somewhere in the fine print, there is a room rent limit. Typical limits range from 1 to 2% of your sum insured. So, on a 10 lakh policy, your room rent limit is usually 10,000 to 20,000 rupees per day. What most Indians do not understand is what happens if you stay in a room more expensive than your limit. You think, no problem. I will just pay the extra room cost out of pocket. The insurance will cover everything else. That is not how it works. Indian health insurance uses something called proportionate deduction. If you stay in a 20,000 rupee room when your limit is 10,000, the insurance company will only pay 50% of your entire hospital bill, not just the room cost, the entire bill. Surgery, medicines, doctor fees, ICU charges, everything reduced by half. So a 5 lakh hospital bill could mean you pay 2.5 lakhs out of pocket because you stayed in a room slightly more expensive than your limit. Either buy a policy with no room rent capping at all, which costs slightly more but is genuinely worth it, or strictly stay within your room rent limit. Second, the waiting period trap. When you buy health insurance, certain conditions have waiting periods before they are covered. Initial waiting period of 30 days for any non-accidental claim. Specific diseases like hypertension, diabetes, kidney stones, cataract, hernia, and joint replacements have 2 to 4 year waiting periods. Pre-existing diseases have 2 to 4 year waiting periods. So if you buy health insurance today at age 40 with hypertension, you already have that hypertension is not covered for the next 2 to 4 years. This is why buying health insurance young is critical. The earlier you buy, the more conditions develop after your waiting period expires. Third, the sublimit and co-payment trap. Many Indian health insurance policies have sublimits on specific things. Cataract surgery capped at 35,000, knee replacement capped at 1 lakh, ICU costs capped at 2 to 3% of sum insured per day. And many policies, especially senior citizen plans, have co-payment clauses. You pay 10 to 20% of every claim, regardless of how big the bill is. A 10 lakh policy with 20% co-payment means you pay 2 lakhs on a 10 lakh hospital bill. Here is what to do today. First, pull up your existing health insurance policy and read it carefully. Look for room rent limit, waiting periods, sublimits on diseases, and co-payment clauses. Second, buy your health insurance young. Premium for a 30-year-old is 12,000 to 18,000 rupees annually for a 10 lakh family floater. Premium for a 50-year-old is 35,000 to 60,000 rupees for the same cover. The math is brutal. Third, get health insurance for your parents before they turn 60. Senior citizen health insurance after 60 becomes either prohibitively expensive or unavailable. Star Health Senior Citizen, HDFC Ergo Optima Senior, and Aditya Birla when active care are options, but premiums can run 50,000 to 1.5 lakhs annually. Now let us talk about scam number 4, which is the bank distribution scam that pulls all three of the above scams together. Every major Indian bank now operates a financial products distribution business on the side. They sell mutual funds, insurance, ULIPs, and other products through their relationship managers. According to RBI and IRDAI disclosures, top Indian banks earn anywhere from 15 to 35% of the non-interest income from selling third-party financial products. This creates a fundamental conflict of interest. The bank is supposed to be advising you, but the bank is also incentivized to sell you specific products that pay them the highest commission. Here is the typical sales pattern. You walk in to deposit a bonus or settle an FD. The relationship manager checks your account, sees you have decent savings, and starts a conversation. Sir, are you doing any tax planning this year? Have you thought about wealth creation? Let me show you something our portfolio team has shortlisted just for clients like you. Then they pull out a glossy brochure for a ULIP, an endowment plan, or a high commission mutual fund. The numbers look impressive. The chart shows guaranteed growth. 20 minutes later, you have signed up. Your bank just earned a hefty commission. The relationship manager just hit their monthly target. You walk out feeling like you have been advised. You have actually been sold to. Here is the rule: banks are sales channels, not advisory channels. Treat every financial product recommendation from your bank manager exactly like you would treat a recommendation from a car dealer trying to sell you the latest SUV. They are not lying. They are not being dishonest. They are doing their job. Their job is to sell you their products. For genuine financial advice, look for SEBI-registered fee-only investment advisors. These professionals charge you a flat fee for advice, typically 25,000 to 75,000 rupees annually, and do not earn any commission from product manufacturers. Or use the simple framework: index funds for equity, PPF, EPF, and NPS for safe long-term growth, pure term insurance for life protection, pure health insurance with no riders, sovereign gold bonds for gold. Done. The simpler your portfolio, the harder it is to scam you. Now, let us talk about the uncomfortable truth behind all four of these scams, because once you see this clearly, you cannot unsee it. These four scams operate openly in India because the entire financial system is incentivized to keep you confused. Confused customers buy more products. Educated customers buy fewer, simpler products. The industry makes its money from confusion. You do not need 15 mutual funds. You do not need ULIPs or endowment plans. You do not need every rider attached to your health insurance. You do not need to take advice from someone whose paycheck depends on selling you something. You need clarity. You need simplicity. You need to understand exactly what you own and exactly why you own it. Pick one scam from this video. Maybe you have 12 mutual funds and need to consolidate. Maybe your parents are holding 3 endowment policies. Maybe your health insurance has a room rent cap. Maybe your bank manager is calling you next week to push a new product. Pick one. Fix it this week. Then come back to this video and fix the next one. Small, consistent corrections compound just like your investments. Drop a comment below and tell me which scam hit you the hardest: the mutual fund overlap, the ULIP your parents bought, the health insurance trap, or the bank push. I read every single comment. Subscribe to Shivani Talks Money for more real personal finance content every week. And if you want to know the exact order in which you should be investing your money in India, the smartest 7-step priority sequence most Indians get completely wrong, go watch that video right here. I am not a financial advisor. Everything in this video is for educational purposes only. Please consult a qualified SEBI-registered professional before making major financial decisions. Take care of your money. I will see you in the next one.